Welcome to Growthwise's Federal Budget 2026 update. Alan, what's the simplest way to explain last night's budget?
Get ready to bend over and pay more tax.
Yep, unfortunately, small businesses were not the winners last night. It is definitely the worst budget for small businesses in a very, very long time. So we've got a couple of big ticket items to cover. Let's start with some quick updates.
Yep. Quick updates. We've now got a $250 tax offset for working Australians, so people that are earning salary and wages. That won't start till the 1st of July 2027, so it's the 28 tax year we're looking at there. We've got income tax cuts for those earning over $18,000. So people that effectively have a $45,000 income will pay at roughly $268 less tax in the year. So very small win there, but a win nonetheless. And the big one that people probably paid attention to last night for the salary and wage earners is this immediate deduction for $1,000 for people without having to have receipts for it. So the government's going to allow people to put that in their tax return, but for those that obviously claim more than that, they can still do it, but you will still need receipts.
And it doesn't start till the 1st of July 2027, so it's 2026, sorry. So for this current financial year, it's status quo. Have your receipts, claim your deductions, and then potentially next year you might have a simplified way of doing your tax return.
So for those people that think the government was looking after small business, I'll let Steph talk about the actual huge changes that were announced last night.
So let's start though with a couple of little things. The instant asset write-off that we talk about every year, I think we've talked about it for the last 6 years of, it's supposed to stop next year. Well, that's now been made permanent. So as a reminder, if you buy an asset, say a piece of equipment worth less than $20,000, you can claim it as a tax deduction in the year you purchase it, as opposed to having to depreciate that. So remember, this is not a $20,000 refund. It's a tax deduction. You have to be paying tax in order for this to be of a benefit. But if you buy an $18,000 piece of equipment, you're basically getting $4,500 as a tax credit or tax refund if you've paid the tax already. The other good thing for small businesses was the loss carryback rules. So this doesn't start until the 1st of July 2026. So there's no benefit for the current year we're in. We have to wait. But effectively, if you make a profit next year, or this year as an example, and you made a loss next year, you'll actually be able to claim that loss back against this year's profit. So practically, if in this current year, FY26, you made $100,000 profit, you would pay $25,000 tax. In FY27, if you made a loss of $60,000, you could carry that back and you get a $15,000 tax refund on that $25,000 tax that you've paid. So sure, helpful for those of you who might be investing in things, certainly using the $20,000 instant asset write-off, which means you might make a loss. There's a little bit of a gain there. A weird one that hasn't really been touched on is pay-as-you-go instalments. So for those of you who own companies, run small businesses, you have to pay your pay-as-you-go instalments on a quarterly basis. So this is a prepayment of your year-end tax. The ATO want to bring in something from 1 July 2027 whereby you pay this on a monthly basis. And the kicker here is they want to basically log into your accounting file, so i.e. Xero. They want to have a look at how much profit you have made and get you to pay tax based on that. So the good news is if you are a compliant person, i.e. you've actually been lodging everything on time and paying your tax on time, you won't be forced into this system. It's an opt-in. If you're non-compliant, i.e. if you've got tax debt and you haven't been lodging on time, you'll be forced into this system. So again, it's really important to make sure all of those lodgements are up to date, on time, and that you're paying your debt. Now, to the three big, incredibly large changes. What's happening with negative gearing?
Negative gearing's been talked about for probably the last 5 years, but actually last night they took big action on this. It's a big ticket item and there's a lot of changes. So stay tuned because there's a lot to discuss. The government is trying to use this as an excuse to get young people into the housing market. So how they're going to do that, we don't know. All we know is the impact it's going to have for the investors and what that actually means. So if you have a new house build, so you're buying something new or off the plan, then you're going to be safe. These changes will not affect you. Or if you have a commercial property where you're actually negative gearing, you will be safe. And the same applies outside individuals into companies and super funds. So that's an important distinction to make. Where the tricky part comes in now is if you buy an existing property, you will be safe until the 30th of June 2027. But after that, if you have a negative return on your asset, so negative means your expenses are more than your income, that means you won't be able to claim that against your other income that you pay tax on. So it'll be quarantined and you won't be able to use it, which is a big loss for people that have plans on building wealth and having an eventual capital gain at the end of the day on their properties. And then we have this in-between period where what if you buy after today, before the 30th of June 2027, and then after that, what happens? So you can continue to negatively gear until the end of next financial year, but then it's quarantined.
And so surprisingly, we've got this touted, we're simplifying the tax system, but all this does is make everything more complex, because if I already own the property, I just get to negatively gear, which, okay, that's great. If I buy new, I still get to negatively gear. Okay, great. But then I've got this weird transition period between last night, 7:30 p.m. to be exact, and the 30th of June 2027, whereby I get to claim it and then I don't get to claim it. So this will be really important as everyone is actually looking at the cash flow impact of buying investment properties and not therefore getting that tax refund.
It's especially important when we talk about the next big topic, which is the capital gains changes, because obviously one of the reasons to go into a negative gearing arrangement is you're going to get capital growth on the property and you'll get a concessional tax treatment at the end when you sell that property. So let's talk now about the changes to capital gains tax.
And I think I want to start here by saying this is really important. The changes to capital gains tax are not quarantined to property, right? These changes apply to shares. They apply to business sales, which is really, really important for people to understand, because that's where the biggest impact will be overall. So from the 1st of July 2027, the 50% CGT discount is going to be abolished, and it's going to be replaced with the indexation method, which stopped in 1999, so a long time ago. And so what happens today, if you purchased a property 2 years ago, let's say for $500,000, and then you sell it today for $700,000, you've made a capital gain of $200,000 on that property. Now, I would normally apply the 50% discount, and my taxable capital gain is $100,000, and that's what I pay tax on, not the $200,000. And so again, we have this incredibly complex scenario and regime of dates for when you actually have purchased something and not purchased something. So assets purchased and sold before the 1st of July 2027 are grandfathered, and we can still use the 50% discount method. So that means that everyone should actually be looking at every asset they currently own now and working out the scenarios of what selling something would mean between now and the 30th of June 2027 to be able to use this 50% discount method. And please pause, because there's another kicker that we'll get to later. So for any assets that you purchase after 1 July 2027, you're going to be paying capital gains tax under the indexation method. So there will be no more 50% discount. If you purchase the asset prior to the 1st of July 2027, including things you own now, and you sell them post 1 July 2027, you'll be subject to this weird, complex hybrid approach that, again, we're actually waiting for the finer details on, because that obviously was not included in the budget papers. But what will need to happen in practice is every asset that you own on 1 July 2027 will need to be valued, because you'll be able to use this 50% discount method on the value up to that date, and then you'll be using the indexation method post that date. Now, there was a little fine print in there that said we might be able to actually use an ATO method, but I can guarantee you that will not be a favourable method for anyone selling assets. So What's indexation?
Indexation, put simply, is using a cost that you have adjusted for CPI. So when you hear on the news the inflation targets, that's effectively what it's being adjusted for.
And so for property, it can sometimes work where inflation certainly has been very high over the last few years, and therefore my cost base of my property would be the inflated from CPI cost base of the property. And so for some of those things, you may actually pay less capital gains tax on the property today using indexation, given the fact that we've had really, really high inflation. But again, this is a toss-up because what will inflation do in 5, 10, 20 years' time? It makes holding the assets for a long time and trying to map out what you could actually get as a after-tax return incredibly difficult. Kicker number one of this capital gains tax issue, though, is that this is now going to apply to pre-CGT assets. So normally assets purchased before 1985 are sold capital gains tax free. Now, those assets are going to attract tax if they're sold after the 1st of July 2027. So again, the purchase date, really, really important.
Kicker number two, which makes this even more complicated and even more of a bend over for the taxman, is you're also going to pay a minimum of 30% on your capital gain. So using Steph's example, if you work out that you've got this inflated cost base where you've calculated your capital gain, even if you're not working and you're no longer earning other income, you are still going to pay a flat rate of tax of at least 30% on your capital gain, which for a lot of people that might wait until they stop working, for instance, and then sell assets off to minimise tax, that's not going to work for you anymore because you'll be paying 30% whether you've got other income or not.
And the same is true for young people who might be doing some investments where they might not have a marginal tax rate of 30%. If they are trying to actually build their wealth, buying shares as an example, and they sell those shares to then go and actually purchase a property, they're now paying 30% tax. And at the moment, they could be paying as little now as 15%. So kicker number two, we also do not like.
And the other kicker that I'll let you describe, Steph, is the impact for a lot of our clients who are small businesses. The removal of a discount has a massive impact on that final balance that you will have when you are lucky enough to sell your business at the end of your working life.
Yeah, and so now we have this thing called the Small Business CGT concessions, and there's a whole host of rules, so I won't go into them, but let's assume you sell a business for $5 million and you pass all of these complex rules. You actually get to use the 50% discount method now. You get to use something called an active asset, and you might get to use the retirement exemption and a whole host of other things as well. But if we just stick with the general 50% discount and then the active asset, that $5 million capital gain, we divide by 2, so 2.5 using the discount, divide again by 2 to get down to 1.25 for that actual active asset. And so your taxable gain is 1.25 million. On that $5 million sale, unless, because most businesses don't have a cost base, therefore we're indexing nothing unless you've physically gone and purchased that business, we no longer get that $2.5 million discount, which means we are paying tax on the $2.5 million, not the 1.25.
And a lot of tax.
A lot of tax.
Yeah.
And so this really detrimentally affects small businesses way more than what the government is actually letting on. And look, I hope we don't have these rules coming into play tomorrow, which is great. And so hopefully there'll be some carve-outs and there might be some different rules for small businesses. But currently it is absolutely diabolical.
And the third kicker, just to add to all of that, is discretionary trusts. So people that have the ability to either have a business that's running through a discretionary trust and distribute that out to beneficiaries, be it individuals or to a company, can currently do that without any tax impost. They can do it and you pay your effective marginal rate, and that's quite an effective system for a lot of business setups. The proposed changes last night mean we're getting another tax come in, so that's another minimum 30% tax on discretionary trusts. So that's 30% on every single dollar of profit that you have, which is an impost to a lot of people that currently have their setups that way. So there'll be a lot of changes that will be required for people that are operating under that structure to reorganise themselves, because in a lot of instances it may no longer be appropriate for them to do it.
Yeah, and it's ridiculous because at the moment, if you run a small business via a company, you're only paying 25% tax. And so there is again this mismatch. If the government one more time tells me that they're simplifying red tape and trying to make things better for small businesses, I mean, honestly, this stuff is just more and more complex. And sure, I get it, they're trying to make sure that people aren't dodging tax, but all it does is add more and more layers of red tape to small businesses. And the kicker for this is a lot of small businesses will have a family trust and they might distribute to some adult beneficiaries. And yes, they're getting a tax benefit for that because the adult beneficiary might be paying 15 cents in the dollar tax as an example. But there are a lot of people who then distribute to a bucket company, and they use that bucket company to go and buy other assets, to build wealth and to do things ready for their retirement. Based on the current legislation, the bucket company does not get the actual 30% tax credit that has been paid, which means we now have double taxation. So we actually can have a company that is paying 55% tax. Yes, you heard me, 55, and it can get worse, but 55% tax on that actual earnings. You tell me how that is reducing red tape or doing anything at all to actually promote building assets and wealth in this country. So fingers crossed we actually get something in the budget papers as they progress and as we get through the parliamentary process that really changes that for small businesses. There is one caveat here, right? So this does not come into play until 1 July 2028. We will also have an ability, supposedly, from the 1 July 2027 to do a restructuring process whereby you won't be penalised by paying more capital gains tax if you restructure away from or change shareholdings or do something to get away from family trusts into another structure. Yeah. So all that tells me is that we're going to be doing an enormous amount of restructuring from the 1st of July 2027 to the 1st of July 2028 to make sure people are not paying 55% tax. But wait, Alan, there's more.
What? There's more?
There's more.
There's more. So we've got other changes coming in that are probably not as big ticket items for other people, but it's important to actually be aware. We've got changes that have been announced last night to the R&D system. So for our clients that have been in business for a while and invest heavily in research and development, there's going to be a change around your ability to claim that back as a tax refund if you've been in business for 10 years or more. So we're waiting for some more detail on that, but that's actually going to have a big impact for people who are trying to innovate and create new things and solutions, and yet another impost for them. We've got Payday Super coming in from the 1st of July this year. So that's going to start 1 July. So that's basically a month and a bit. And then businesses will actually have to start paying their super as well as their wages per pay run.
More red tape.
More red tape. Then for people that are in the higher net wealth position, we've got this Division 296 tax that was announced last year that's now in play. So that's additional tax that you pay on your earnings for balances over $3 million or more inside your superannuation. So more tax, more tax, more tax. And then the other thing that was announced and is now in play as well for people that have got legacy tax debts is the interest that the ATO charge you is also no longer tax deductible. And that's a big thing for people to think about when they're trying to plan their finances, because the ATO love charging interest and that's not at a low rate, and it's actually a big impost for people to be able to repay those debts.
Yeah, 10.96% at the moment, so definitely not a low rate. And the days of the ATO remitting general interest charge are basically dead in the water. They definitely will not do that at the moment. So it is really important to make sure you are putting away for that tax and have a plan if you do have some of that legacy tax debt from previously.
Okay, so there's a lot of things in that budget and there's still more coming out, so we will keep updating you as you go. What's what's from now, Steph?
So tomorrow we're having a live session for our clients in our community platform circle. So that'll be at midday. Everyone should have their invites to that. We'll also record that as well if you can't make midday. We will, of course, be updating everyone and be doing some scenario planning as more detail comes to light. Obviously, this has to be passed, right? So there's only a few things that are actually in play, i.e. Payday Super and the obvious Division 296, but the rest of it isn't actually passed. So we'll need to wait for that full legislation. Fingers crossed there are some working groups and we might have some changes there, and we'll keep you up to date as we know things. But thanks for joining us for this federal budget update. At least there was something that was actually new, although for all of our clients and for small businesses, it was certainly not exciting. It was pay more tax and have more red tape.
Thanks, everyone.